Hey everybody, Steve here, and welcome to today's explainer. Listen up, because today we are breaking down a massive, high-volume rocket ship ride on the tape. The market didn't just stabilize into the closing bell. No, it staged a violent, multi-asset short-covering squeeze that completely rewrote near-term resistance levels. Now, while the mainstream news is out there frantically scrambling to chase those green bars, our job on this desk is a whole lot simpler and honestly a lot more ruthless. We track the hard numbers. We look at the exact underlying mechanics that shifted this capital. So, stop looking at the noise and start looking at the structure. Let's open the ledger and figure this puzzle out together.
Just look at this number, 7,431.46. I want to slam this S&P 500 futures true settlement number right on the desk for you. Because this isn't just a daily close, guys. This shows the sheer violence of the bulls taking the wheel and absolutely stomping on the gas. S&P futures, or /ES, just exploded today, shedding all the recent red and screaming higher to lock in this exact print. It's a pure display of raw structural buying power.
But to really grasp what's happening, we got to immediately pivot over to this number, 88.13. This is the Brent crude plunge. I want to establish this jarring visual contrast right off the bat. Over in the energy pits, the active July paper contract went into an absolute freefall, anchoring right here at 88.13. So you've got energy bleeding out on one side of the screen, while equities are going completely vertical on the other. That divergence is literally everything.
All right. Consider this your locker room briefing before we hit the trading floor. Here is exactly what we're covering today. First, the violent intraday squeeze. Second, unwinding the war premium. Third, the crude oil freefall. Fourth, SpaceX liquidity and yields. And finally, surviving the FOMC landmine.
Okay, let's jump straight into Section 1, the violent intraday squeeze, assessing the damage. I need you to command your attention and look straight at the board as we dissect this sudden, blinding green flash across multiple asset classes. This wasn't some slow, casual drift upward. This was a coordinated, aggressive mechanical sweep. Let's run through the daily market performance dashboard rapid fire. We already talked about the S&P 500 futures, surging a massive 2.26%, and Brent crude collapsing nearly 2.5%. But look at the anomaly here. Spot gold actually clawed its way back above key psychological levels, printing a technical bounce to hold at $4,216.44. And down at the bottom, Bitcoin caught a massive risk-on wave, expanding nearly 3% to trade back up at $63,559.10. To understand why the screen suddenly flipped like this, we've got to look directly at a massive geopolitical plot twist.
Which brings us to Section 2, Unwinding the War Premium, the core catalyst.
We're stepping behind the curtain now to reveal the core catalyst. For the last few sessions, programmatic desks were pricing in severe war risk premiums due to active military exchanges between the US and Iran. The market was literally terrified of a permanent supply chain lockdown. But then, the White House completely flipped the script. Here's the mechanical chain reaction that followed. Step 1. The White House announces a sudden de-escalation framework and the freezing of offensive operations. Now, the absolute moment that announcement hit the wire, Step 2 kicked in. A massive, violent unwind of defensive hedges began instantly. And because of this sudden shift, Step 3 happened. Millions of dollars in short positions were trapped in the blink of an eye. Let's take a quick moment of silence for the bears caught completely offside. All right, silence over. Which leads us to the final stage. Automated market makers are forced to aggressively buy back futures contracts just to clear their books. The crucial takeaway here is that this mechanical short squeeze is the exact fuel that sent equities absolutely vertical. The shorts literally funded the rally.
All right, moving to Section 3, the crude oil freefall, corporate tax cuts.
Let's shift our focus strictly to the energy pits, because this is where that de-escalation hit the hardest, and where the fundamental story really takes shape. Oil went into a state of absolute freefall. Now look at the direct, fundamental link happening here. On one hand, massive equity expansion. On the other, the Brent crude collapsed down to 88.13. This collapse in oil premium is a massive, vital piece of correct analysis. Why? Because it acts as an immediate corporate tax cut across the entire S&P 500. Lower input costs and cooling logistics pressures mean corporate profit margins instantly expand. The fact that oil bled out while the S&P skyrocketed basically confirms that the macro release valve is wide open. It gave equity bulls the perfect fundamental justification to hold these higher, highly aggressive levels.
Next up, Section 4. SpaceX liquidity and yields, the macro release valve.
You know, energy wasn't the only pressure valve releasing today. We need to move over to the fixed income and crypto desks to show how a massive macro liquidity drain finally eased up, providing even more structural support for this rally. Make sure you fire these structural shifts into your notebook. Following the geopolitical news, long-end U.S. Treasury yields caught a strong bid. That cools down the risk-free rate, which immediately lifts the automated valuation ceiling on tech and growth equities. But here's the really massive liquidity event. The historic SpaceX IPO finally priced and debuted on the Nasdaq. With that huge cash call out of the way, capital actively flowed back into the markets. You saw it instantly in crypto. Bitcoin absorbed a hot 6.5% year-over-year PPI print, with buyers aggressively defending the $59,000 to $60,000 demand zone. That SpaceX cash return stabilized the tape and fueled a broader risk-on environment across the board.
Finally, Section 5, Surviving the FOMC Landmine, Professional Trading Directives.
All right, pivot with me from the historical post-mortem to the urgent survival guide. We know what just happened, but how do we navigate this massive trend expansion without letting FOMO make us sloppy heading into the weekend? Listen to me very carefully. Stop chasing the highs of a green rocket and trade the hard-moving averages on your screen. Looking at the technicals, today's massive spike to 7,431.46 means price action has aggressively reclaimed its short-term daily 20-day simple moving average. More importantly, it firmly defended our primary structural anchor, the upward-sloping 50-day exponential moving average. As long as the S&P futures hold above that 50 EMA on a weekly closing basis, the primary bull market is structurally protected and open for further upside expansion. Keep your eyes pinned to that crude contract at 88.13. If energy stays suppressed, it clears the runway for the equity bulls.
But here's the grim reality you absolutely have to respect. Listen to this quote right here. The Fed remains locked in its official pre-meeting blackout window, leaving the market entirely vulnerable to heavy structural positioning. As the trading week wraps up, institutional desks are shifting all structural focus away from this week's inflation prints to the next massive multi-day macro landmine dropping June 17th and 18th, the FOMC meeting and interest rate decision. Because those May CPI and PPI prints came in hot and sticky, options markets are already pricing severe event risk into next week. Programmatic funds are aggressively recalibrating their hedges right now. Volume is going to remain highly sensitive to any sudden shifts on the Treasury desk. Track these levels with absolute defense.
Which brings us to the final and undoubtedly most important question for anyone operating on this desk. Are your stop losses respected and your position sizing managed before the ledger closes? Do not let the blinding green flash of a short squeeze blind you to the hard mechanics of risk management. Let the numbers dictate your execution. Do not trade on emotion. The ledger doesn't wait for latecomers. The real question isn't whether you survive today's squeeze, it's whether your portfolio is structurally armored for the volatility storm Powell is about to unleash on June 17th. So, are you ready for the landmine?